and moderation in urban growth. The secular trend of premiumization remains resilient, with premium segment growing ahead of mass segment. When it comes to commodity prices, we continue to see year-on-year inflation in crude palm oil and tea, while soda ash largely remained benign. Crude oil prices continued to deflate during the quarter, and rupee depreciated by around 1% against the dollar. However, over the last couple of weeks, crude palm oil, crude oil, and USD INR rates have witnessed some volatility. We have continued to maintain agility in this environment, pricing in line with net material inflation during the quarter. In this backdrop, we reported a turnover growth and a turnover of 15,195 crores with an underlying sales growth of 2% led by pricing. Underlying volume growth remained flat for the quarter. While absolute volumes grew competitively, it was offset by a negative mix. We continue to maintain healthy margins with our gross margin at 50% and EBITDA at 23.5%. PAT BEI at rupees 2,540 crores remained flat year-on-year. EPS grew by 19% year-on-year. The difference between the two is mainly on account of profit from disposal of Pureit business. During the quarter, we continued our journey of sharply executing the three pillars of our strategy: focus, excel, and accelerate, while steadfastly upholding our foundational pillars of sustainability and culture. With a renewed approach towards portfolio segmentation, we have classified our portfolio into core, future core, and market makers to strategically prioritize investments, maximizing growth. Let me talk about some of the key highlights for the quarter through this lens. Core brands are the foundation of our categories. Glow & Lovely's Glass Bright Gel Cream and relaunch of Rin Bar with superior technology are two examples of how we have continued to modernize and contemporize our core brands with superior R&D and deep consumer insights. In our future core portfolio, we have identified 10 aspirational brands that we intend to transform into big master brands. Taking the example of Dove Scalp Plus Hair Therapy and Serum Shower Collection, both have been co-created with dermas to bring pioneering hair and skincare benefits for consumers. With the digital-first launch model and Other Say campaign, we're further expanding our play in fast-growing premium segment. With Market Makers portfolio, our effort is towards leading and creating trends to develop the maker market in 6 segments of choice. With a social-first media approach, we launched Lakmé's Rouge Bloom range and TRESemmé's Silk Press range, expanding our masstige offerings. Knorr joined forces with Squid Game 2 for a one-of-a-kind digitally interactive campaign to promote its Korean ramen range. We have continued to drive sharper portfolio choices during the quarter, including divestment of water business, decision to demerge ice cream business, and our recent acquisition of Actives-led premium beauty brand Minimalist. Let me take a moment to give you an update on all these transactions. We have completed the sale of our water business on 1st of November, received consideration and recognized profit for the same this quarter. Coming to ice cream, we previously spoke to you about our intent to separate the business. The board of directors has approved a scheme of arrangement for demerger of the business into Quality Walls India Limited. With iconic brands such as Quality Walls, Cornetto, and Magnum, our ice cream category is a great business operating in an attractive segment. The 1:1 share entitlement ratio will unlock fair value for HUL shareholders and give them the flexibility to stay invested in ice cream's growth journey. Today, we also announced the acquisition of stake in Uprising Science Private Limited, which owns the brand Minimalist. Founded in 2020, the brand sits at the intersection of beauty and actives-led science with sharp positioning and masstige pricing. With an annual revenue run rate of rupees 500 crores, we have entered into an agreement to acquire 90.5% stake through secondary buyouts at a pre-money enterprise value of rupees 2,955 crores, which is subject to adjustment as per transaction document and primary infusion. This acquisition is in alignment with our strategic intent of transforming our B&W portfolio in high-growth premium spaces. We are excited to welcome Minimalist team into HUL family and are confident of unlocking value through synergies and complementary capabilities. The transaction is expected to be completed in Q1 of financial year 26, subject to requisite approvals. Additionally, the board of directors has approved the acquisition of palm undertaking of Vishwatej Oil Private Limited. This is a part of HUL's localization strategy for palm to build supply chain resilience for palm derivatives through backward integration. With this acquisition, HUL has taken a step forward to build infrastructure for palm under the aegis of India's National Mission on Edible Oils. Moving on to performance across the segments. Home care, our largest segment, grew 6%. The segment delivered a high single-digit volume growth. Beauty and Wellbeing delivered a modest growth, growing at 1%, while UVG declined in low single-digit. Hair care continued its competitive growth momentum, while skin care was impacted by delayed winter. Personal care declined by 4%, driven by a mid-single-digit decline in UVG. Strategic actions led to improvement in competitive performance, while revenue was impacted due to decline in hygiene segment of skin cleansing. Foods revenue remained flat, while UVG declined in mid-single-digit. The segment saw a sequential improvement in beverages and packaged foods. Margins in all four segments remained healthy, with home care at 18%, beauty and wellbeing at 29%, personal care at 18%, and foods at 20%. Summarizing our performance for 9 months of financial year 25, USG was 2% with a UVG of 2%. Gross margin remained above 50%, and EBITDA margin remained healthy at 23.7%. PAT BEI was flat, while PAT grew by 6%. Looking ahead in the near term, we expect moderation in demand trends to continue. In this context, our focus remains on driving competitive volume-led growth across our portfolio, prioritizing investment across core, future core, and market makers portfolio. If commodity prices remain where they are, we expect a low single-digit price growth in the near term. Amidst inflationary market prices of materials, we expect to maintain EBITDA at lower end of our range of 23 to 24%. We will continue to manage our business dynamically, driving savings through a net productivity program and provide the right price-value equation to our consumers. We remain focused on our job of transforming the portfolio. The mid to long-term opportunities in the FMCG industry is immense. With strategic clarity and operational excellence as our foundation, we are well positioned to leverage this opportunity and grow competitively. With this, I complete my prepared remarks, and we can now take questions.
Thank you, Ritesh. Shilpa, would you like to ask the first question? We'll come to you, Sesa. Shilpa? Okay, Sesa, you can ask the first question, please.
Right. So thank you for the opportunity. So, firstly, I would like to know, how is the current demand scenario looking like? As we speak, are you seeing any signs of improvement in urban demand? And also, are there any near-term triggers that you think would aid demand going forward? That is one. And second, on the minimalist deal, if you could give some more insights into, how this fits into HUL's overall strategy, as we know that the company is focusing on, sharpening its BPC focus. So on those lines, if you can just share some insights.
Maybe I can speak to the market trends and then request Ritesh to give you some understanding in detail on the minimalist joining our family. On the market, we clearly see rural gradually improving consistently over the last few quarters, and that's good news. Urban, on the other hand, continues to moderate in terms of growth, and at this point, we see that trend continue in the near term. As a result of which, the overall market is muted because it's a combination of these two sectors. We expect going forward, given the good signals from both the Kharif and the Rabi crops, that the rural markets will improve. And on urban, it really depends on the macro factors. But as far as we are concerned, as I have been saying in the past such calls as well, that our job is to do what we can control, which is to go where the growth is, invest behind our operational efficiencies, grow competitively, which we are indeed. We're growing competitively across our business by way of volume. And importantly, we will at the same time keep doing what we need to do to be future fit, which is basically as our strategy, which we shared in our capital markets recently, contemporize our core, premiumize our future core, and lead market making. So we're very focused on doing both the operational excellence, competitive growth in the near term, and our strategic investment in the long term. And minimalist is a great example of how we are investing behind building a portfolio, especially in B&W, that's absolutely fit for the future, and probably a great segue to hand over to Ritesh to speak about the Minimalist brand and why we're so excited about them joining our family.
Yeah. We had mentioned about our own strategy of beauty and well-being, where one of the key imperative for us is to improve and increase our share of the premium portfolio. Minimalist as a brand is deeply rooted in product efficacy and consumer love. The brand operates at masstige price segment within skincare and hair care, and which is why it is a fabulous fit to the portfolio of Hindustan Unilever. It has a very good presence online and hence strengthens our position on e-commerce as well. We have acquired the business at an enterprise value of 2,955 crores. The brand today has basically in the last 4 years' time grown to become a 500 crore business and also profitable. We acquired the business at 5.9 multiple, and we believe that once we unlock synergies of Hindustan Unilever and bring that, so the team Minimalist and team Hindustan Unilever put together can come and create a bigger version of Minimalist, and the synergies that will unlock will also be able to invest more behind the business and realize the potential that the brand has.
Right. And if I can just squeeze one more in, with the rise of quick commerce, as a preferred channel, what is the percentage of your sales coming from e-commerce, and also how much of that is contributed, from quick commerce?
As I mentioned before, e-commerce obviously continues to grow faster than the rest of our business. Still, it's below double-digit contribution at the moment to our business. Within that, quick commerce is indeed growing faster. And I will not be able to share with you the exact share of that, but it is clearly increasing its contribution to the total e-commerce business in our case. We are very mindful of our models, where we have a very clear intentional strategy of differentiated assortment by channel. We serve an omni-channel consumer who's shopping for different shopping missions. The quick commerce consumer and the shopper is increasing in their shopping mission. So clearly all the platforms are now, so we have the convenience mission. We also have, the indulgence mission. So therefore including, we are increasing our assortment in quick commerce, and we are also therefore clearly growing quite high in that channel. And we intend to make sure that we are competitive in that channel and make sure that the assortment is clearly differentiated so that we serve the shopping missions that the Kirana stores are there for, and we also make sure that there's little overlap between the two channels.
All right. Thank you so much. I'll come back in the queue.
Thank you, Sesaj. Shilpa, would you like to ask the next question?
Yes. Hi, gentlemen. Can you hear me?
We can.
Yes.
Hi, good evening. Congratulations on the acquisition also of Minimalist. Just at the risk of a little bit of repetition, I just want to come back to talk about what are we looking at going ahead in terms of urban demand. The numbers suggest that the situation has not really improved a lot. How are we supposed to now look at the entire demand scenario going forward? And a little bit, if you could touch upon rural as well, and also in terms of inflation, I believe some price hikes were taken in soaps and the tea portfolio. How much more of price hikes can we expect going forward? And also, if you could, give us a little more lowdown on how on the ice cream business separation, and also any timeline, if you could share with us on the listing and all of that.
So I'll speak to the market, and Ritesh will take the questions on pricing, inflation, and ice cream. On the market, first of all, I know we are reacting to a quarterly trend, even an in-year trend, but let's not first of all forget that we are in a very exciting consumer market of the decade. The per capita consumption across all our categories are extremely low. When you look back from a more of a wider lens, we can clearly see all categories that we compete in and build are going to grow exponentially 3 to 4 times. Take any market which is in our neighborhood, we're going to see growth there. Now, in the near term, there'll always be fluctuations, and no line of growth is stable or clearly predictable. At this point, a year or two back, we were talking about how rural was compressed, but now we see rural coming back. It's consistent, it's gradual, but it's consistent growth. We expect also that the future signals in terms of the monsoon and all of the signals we pick up from the rural are good. But at the same time, urban that was carrying was doing the heavy lifting of growth for the last few quarters is compressed and is muted. But we should not, try and extend this beyond what we can see in the near term, which is maybe a quarter or two. But I think we, as a leading company in serving our consumers, our job is to invest for the future, do what's right for our consumers, and importantly, in the near term, the best we can do is what we can control, which is, are we executing well? Are we innovating extensively? Are we serving our consumers in a superior way across all our 6 Ps of our brands? And we are exactly focused on that. And that's the reason why our near-term metric is competitive volume growth that is profitable, and we are delivering that. At the same time, we are investing for the future, and Minimalist is an example of that intention. But I'll now request Ritesh to take the other points that you asked.
Ice cream, Shilpa, it will take little about a year from today for us to finish. So we expect in March quarter 26 to finish the whole process of getting all approvals and getting the company listed. That's our current timelines. Of course, this is subject to appropriate approvals along the way that we'll end up taking. Coming to your question on pricing, and from a commodity perspective, today crude oil, which impacts, let me say, home care and many other parts of the business, that's benign. We have seen inflation in crude palm oil and in tea. And hence, both in soaps and tea, we have taken price increases about 4 to 5% in the current quarter of December, as we reported results. And this is always a policy that when we see price increase of commodities, we take price increase in small chunks. Once we have a more deterministic signal of total quantum of inflation, then we do the balanced job of taking either further price increase, but more importantly, keep driving savings across all the lines of the P&L. So only the net cost is what we want to end up taking price increases. Now, crude palm oil increased very sharply by 40% in December quarter. But since then, as we speak in January, we have seen it has come off by almost $100. So we will factor that into consideration along with what's happening with Indian rupee volatility and then decide our pricing actions for March quarter. So that's on pricing for both soap and tea.
But I'm just trying to get a sense, like last quarter, I think 2 to 3%, correct me if I'm wrong, was the quantum of the price hikes. Can we expect the same kind of quantum? And also, Videsh, we've been talking about, how last couple of quarters when there was a slightly deflationary scenario, we spoke about, maybe price-led growth is over, volumes will start coming back, but then that situation seems to reverse now. So in terms of whether it's, low single-digit price-led growth that you're talking about could go on for how many quarters? When do you think, I know this is a bit of a crystal ball gazing, but when do you think volume-led growth could come back?
Yeah. So let me first talk about pricing, Shilpa. So, of course, there are 3 big commodities which impacts the portfolio: crude palm oil, tea, and crude oil. If at all we do see, and along with that, very important, the way currency pans out, Indian rupee vis-a-vis, let me say, dollar. These 4 elements determine the total amount of quantum of inflation. Today, we are seeing increase, as I saw and I spoke about, increase in crude palm oil and tea. Both of them have come off in last few weeks compared to the peak inflation that we saw in December quarter. So as I look at 2, and then when I look at impact of crude oil, which at circa $80 is pretty benign. So all put together, our view is that as we see commodities today, we expect a low single-digit price growth go forward. I don't expect a material change to that in near term. Now, when it comes to the mix of volume and value, and hence linked to growth, Shilpa, to your point, this quarter as well, we have grown our tonnage volume ahead of the market, and we have gained volume market share. We also have grown competitively overall, and our turnover-weighted market share is positive. Now, what has happened in the quarter, the tonnage growth that we have, and remember, our UVG matrix that we publish is a combination of volume and mix. So while volume has been positive, even in this quarter, the mix has been negative, which is what has negated the impact of positive volume growth. And on a net basis, we have reported a flat UVG. Now, why has mix become negative? Number one, our home care business has grown ahead of the rest of the business. It's a very strong business, complete portfolio, and has driven extremely well good growth. Home care also operates in essential category where it is very resilient to inflation and deflation. Even in high inflation period, you had seen we had driven positive volume growth in home care business. But when it comes to price elastic skin cleansing and tea, these are always, they get impacted. As you take price increases, volumes do get impacted. So that's, which is why overall at a category mix, we have seen mix getting impacted because of this dynamics. Second, we also have seen small price growth ahead of large price growth as urban growth have basically moderated. So that's a impact, second impact that we have seen. These 2 impacts put together have netted off to some extent because premium overall as a portfolio continues to grow well. But on a net basis, the mix has been negative. Now, we do believe that the dynamics of small pack growing ahead of large pack, given what's happened in urban market, this is transitory in nature. But as far as we are concerned, the job is very clear for us, which is to keep driving growth in the premium part of the portfolio. You heard from us earlier as well that our intention over the next few years is to drive 900 BPS improvement of premium portfolio within beauty and well-being. Today, the acquisition of Minimalist that we have announced is in a direction exactly to deliver that. Launch that we did of Simple Love Beauty Planet, the recent launch that we did of Novology, or for that matter, portfolio expansion that we did of Pond's and Lakme, all these put together will keep driving premium portfolio for us. And this is exactly how we want to also keep improving overall mix of the portfolio.
Right. Thank you.
Thank you.
That would be
Thank you.
management on the third quarter numbers. But on that note, it is time for
Snehi, would you like to ask the next question, please?
Yes, sure. Gentlemen, am I audible?
Yes.
Yes.
Yes, perfect. My first question is on the volumes, because other than home care, we've seen volumes coming in a decline in your other three key segments. Could you help me quickly understand what's causing the pressure? What's your near-term outlook? Because quarter three was a festive quarter, and we expect volumes to see some sort of an improvement year on year, or even on a sequential basis rather. So what has caused this pressure, and by when can we see volumes coming back to those 4-5% levels? Would that be possible in the near future?
If I can just at a meta level, our volumes are ahead of the market. We are gaining volume-led competitive growth. And because we report UVG, which is mix of volume, which is a combination of volume and mix, as Ritesh just explained, our mix this time is negative, which has taken a UVG and made it flat. And that's on account of the fact that home care, which is the big category in our case, is growing quite ahead of the rest of the categories. And we have also an added element of pack mix, where small packs are selling way more than the large packs. And that's specific to this quarter. We expect that to be transitory as things normalize going forward. So that's one reason why the optical number is what it is, which is the underlying volume growth. But we do remain very focused on growing volumes competitively. Insofar as the pattern of volumes are concerned, as I mentioned, rural is coming back, and we see that gradual recovery quite sustained. It's urban where we actually see some more pressure, which is driven by factors that are probably macro in nature. And we remain, of course, as I mentioned, focused on, in these conditions, driving competitive volume-led growth across our categories. And we expect as the markets come back, that we'll have tailwinds on our back and a more competitive portfolio to play with, even in those periods.
And if I probably just add to what Rohit mentioned, let's take example of B&W. Our beauty and wellbeing portfolio for the first half of the financial year grew at mid-single digit. Even in the current quarter, if I take the impact of winter, delayed winter impacted our sales growth of skincare and hence beauty and wellbeing. If I take the impact of delayed winter out, even this quarter, beauty and wellbeing, except that, has grown at mid-single digit. So there is momentum in the portfolio, but there are factors in the quarter, to what Rohit's point earlier, of mixed impact and impact latency of winter. This has impacted the overall outcome as far as internal results are concerned. But as Rohit mentioned, our growth has been competitive. We are positive on our overall value market share, number one. And number two, also volume growths are ahead of, and hence we're also gaining volume market share.
Okay, gentlemen, point taken. Just want to understand a little bit on your hygiene segment. Now, you've relaunched Lifebuoy to address the declining hygiene segment. Hygiene segment still continues to do slightly poorly as per your presentation. Can you tell us what the consumer response has been to the reformulation of Lifebuoy and Lux?
So just to speak to the hygiene first. So hygiene segment is a large segment in the personal wash market. Lifebuoy is a leader in that segment. And in COVID, we did get the benefit of the tailwind of the increased sensitivity to hygiene. Over the last few years, the segment of hygiene has come down and consumers have moved on to other segments in the market. Lux, being a part of the beauty, is therefore gaining share consistently and is doing very well and is really being expanded across all many demand spaces, including sandals. So on the whole, Lux is robust, vibrant, and growing in a growing segment and expanding into white spaces. Insofar as Lifebuoy is concerned, because it's a very important part of our personal wash portfolio. Just to give you a context of our personal wash portfolio, we are a big business with a large, way more than a third share in the market. We have a premium end that's doing competitively with Dove and Pears. Our popular end with Lux is doing quite well. We have a specific job to be done in the space of hygiene, where the hygiene segment is shrinking, gradually over the years, but our share is consistent within that. In order for us to...
Flat volume growth.
Beg your pardon?
And expect low to single-digit price growth in the near term.
We do in personal care wash
But,
the fact that the palm prices have gone up quite steeply. As far as
There's not a flashable line in that entire.
Sorry, as far as Lifebuoy is concerned, it's a really big, great brand for HUL, and we are shipping as we speak. You see that soon in the market. The major changes that we have done Lifebuoy are quite transformational. We have a new formulation using Statros that have given us formulation space to put goodies that allow us to essentially make and deliver new claims. We are transforming its proposition from being just for illness prevention, which is quite narrow and becomes more generic, to technology that allows for skin health and skin health protection. We're using clear, credible sources such as a dermatologist to make that claim more and more sharp and compelling. We are, as we speak, announcing the change in the biggest stage of all, which is the Kumbh, this month, where we'll actually unveil the new Lifebuoy. We have revamped the packaging, made it more modern. We are bringing a new assortment. We're expanding into a freshness demand space, and we're going to back it with really strong investment on media and below the line. So we are going full on to revamp Lifebuoy and make it back to grow again. And of course, we will also see the range expanding from beyond just the toilet soap to other parts of the bathing and shower gel market. So we are pretty committed to make Lifebuoy robust and healthy and stay relevant, as it has been in many, many decades past.
Sure, if I could just squeeze in one last
Snail?
question, just 1 second, just one short question, please. Very quickly, if you could help me understand, you've streamlined your supply chain to Kirana stores, you've lowered credit limit. Could you help us understand the change in the distribution strategy and what's the outlook going ahead?
No, our distribution strategy is not changed. Our distribution strategy is very, as far as traditional trade is concerned, it's a distributor-inclusive, Kirana-centric strategy, because a large share, heart of our business, more than 2/3 come from Kirana. What we have done is, for many years, we have tried to take away in very large metro like Chennai or Mumbai, the hassle and the challenge of managing very high level of distribution complexity, warehousing, and using now technology to basically centralize that for very large metros. It's taken us many years now to perfect that. For one city, we are now in the second city, and it's going to be something that's quite specific to very large metros. It'll take also many years before that entire centralized distribution system can actually expand to just the very, very large metros. And it really does give our distributors the bandwidth, the energy, and the financial capacity to do what they do best, which is serve our Kirana stores, offer them service, both credit and, of course, after-sales service, and make sure they continue to build that relationship that we essentially find is our biggest strength. And our distributors will and have always remained the heart of the HUL's business. And our distribution strategy is clearly, as I repeat, distributor-inclusive and Kirana-centric, and that's not changing. We're just trying a new way of taking away a pain that can be done better with technology in very, very large metros, and it's going to be a slow process of expansion because it's very highly capital intensive and requires customization city by city.
And to Rohit's point, where this is relevant in terms of change to distribution model, as Rohit mentioned, was in large cities. Today we have Chennai, which has gone live sometime back. We followed that with Mumbai, and there are a few more cities over the next few years will end up doing the same thing. And we expect up to 10% of HUL footprint to be distributed differently, and especially in these large metros, as Rohit mentioned.
Thank you. We've come to the appointed time.
Thanks a lot.
Thank you. We've come to the appointed time. Thank you very much for joining us for this results briefing. Thank you.
Thank you.
Thank you.